The 72-hour window. Before the next explosion, do this now. In the window, they don't want you to notice. If you care about your money, watch this until the end, because what happens in the next 72 hours could change your financial future. Right now, something strange is happening in the markets. Bitcoin just got smashed. Silver just got crushed. Stocks wiped trillions in days. Headlines are screaming panic. Social media is full of fear. And yet, behind the scenes, something very different is happening. Because every major financial shock follows the same psychological pattern. First comes fear, then comes confusion, then comes forced selling, and finally, the quiet accumulation phase, where the smart money steps in while the public is still panicking. Most people think crashes are accidents. They think markets just fall. They think price drops are random. But history tells us something far darker. Crashes are not just financial events. They are emotional weapons. They are designed to shake people out of positions at the worst possible moment. They are engineered moments of mass doubt. And when fear reaches its peak, that is when the real move begins. Today, I'm going to show you why these crashes feel so violent, why they always happen when confidence is highest, what smart money does during fake panic, the 3 mistakes that wipe out regular investors, what to do if you already panic sold, and the simple survival plan for the next 72 hours. This is not financial advice. This is psychological survival in a manipulated financial system. Let's begin. Part 1. Why crashes feel engineered. Every major market collapse feels the same. It feels sudden, it feels violent, it feels personal. You wake up and the chart is red. Your phone buzzes with breaking news. Influencers scream, "Sell now." Mainstream media runs emergency headlines. Your brain goes into survival mode. This is not accidental. Markets are not just places where numbers move. They are psychological battlegrounds. Price movement doesn't just reflect value. It creates emotion. When prices crash fast, your brain thinks, "I'm in danger. I'm losing control. I must act immediately." And that emotional reaction is what creates the opportunity for institutions. Big players don't buy when things look safe. They buy when things look broken. They buy when you feel stupid for holding. They buy when your friends tell you that you were wrong. They buy when your partner asks why you're still in that risky thing. Crashes are not just price resets. They are confidence resets. And confidence is the most valuable asset in any market. Part 2. The hidden phase. No one talks about. After every violent drop comes a phase the media barely covers. It's called the absorption phase. Price stops falling dramatically. Volume increases quietly. Volatility calms down. Nothing exciting happens on the surface. This is the phase where retail thinks, nothing is happening anymore. The story is over. But behind the scenes, large players are slowly absorbing supply. This is when big funds accumulate, long-term positions are built. Weak hands finish exiting. Strong hands begin positioning. And most people miss this phase completely because it's boring. There is no drama, no big red candles, no big green candles, just quiet, controlled buying. This phase often lasts days or weeks. And when it ends, the market doesn't just recover, it violently reprices. This is why most people sell low and buy high. Not because they're stupid, but because they're emotional. Part 3. The 3 deadly mistakes that wipe out retail. Let's be brutally honest. Here are the 3 mistakes that destroy most investors. Mistake 1. Reacting emotionally to headlines. Headlines are not designed to inform you. They are designed to capture your attention. Fear sells. Panic sells. Drama sells. When headlines say, crypto collapse, they are not analyzing long-term structure. They are monetizing your anxiety. Mistake 2. Selling because others are panicking. Humans are herd animals. When everyone around you panics, your brain thinks, maybe they know something I don't. But markets don't reward groupthink. They punish it. The crowd always sells after the damage is done. Mistake 3. Thinking crashes mean failure. Crashes are not signs of failure. They are signs of transfer. Wealth transfers from emotional participants to patient participants. That's the ugly truth of every financial system. Part 4. What if you already panic sold? Let's address the uncomfortable question. What if you already sold? What if you already locked in losses? What if fear got the best of you? First, don't beat yourself up. The system is designed to pressure you emotionally. Even professionals get shaken out sometimes. Second, panic selling doesn't mean you're out forever. It means you now have a decision to make. Do you re-enter emotionally or strategically? Re-entering emotionally usually means chasing green candles. Strategic re-entry means waiting for structure to form. If you sold, stop staring at 1-minute charts. Zoom out to daily or weekly timeframes. Look for stabilization. Wait for volume to normalize. Let volatility cool. You don't need to catch the exact bottom. You just need to avoid catching the emotional top. Part 5. What smart money does in the 72-hour window. Here's what institutions do during violent drops. They don't panic. They don't tweet. They don't argue in comment sections. They review liquidity conditions, forced liquidations, sentiment extremes, structural support levels, market positioning. When fear spikes suddenly, it often creates temporary mispricing. The 72-hour window after major panic is critical because forced sellers are exiting, emotional selling peaks, price discovery overshoots, liquidity events settle. This is when markets often stabilize, not reverse instantly, but stabilize. Stabilization is the beginning of repositioning. The public thinks nothing is happening. Smart money thinks everything is happening. Part 6. Bitcoin and silver move differently. But the psychology is the same. Bitcoin is volatile. Silver is volatile. But the emotional patterns are identical. Both are alternative stores of value, distrusted by institutions publicly, quietly accumulated privately, volatile enough to shake people out. The narratives change. The psychology does not. When Bitcoin crashes, they say crypto is dead. When silver crashes, they say metals are outdated. And yet, central banks buy gold. Institutions accumulate Bitcoin. Supply constraints grow. Monetary debasement continues. The disconnect between narrative and reality is the opportunity. Part 7. Your simple survival plan. No hype, no guru nonsense. Here is a simple, boring, effective framework. 1. Stop reacting to intraday noise. 2. Zoom out. 3. Identify structural levels. 4. Avoid emotional reentries. 5. Never allocate money you emotionally need. 6. Accept volatility as the price of asymmetric returns. 7. Plan entries when fear is high, not when confidence is high. This is not about predicting the bottom. It's about avoiding emotional destruction. The people who survive market chaos are not the smartest. They are the calmest. Part 8. Why the next move feels sudden. When markets finally move after manipulation phases, people say, it came out of nowhere. It didn't. The move was prepared during silence. By the time headlines turn positive, the move is already halfway done. This is why most people miss the early phase. Most people buy after confirmation. Most people enter when risk is highest. The explosion phase is not the beginning. It's the ending of positioning. Final warning. This is a psychological game. The system does not reward panic. It rewards patience. The market is not against you personally, but it will always exploit your emotions if you let it. The next 72 hours are not about predicting price. They are about controlling your reaction. If you master your reaction, you master your outcome. If you watched until here, you already know more about how the system really works than most people ever will. And that awareness alone puts you miles ahead of the crowd. Stay calm, stay patient, and never let fear make your financial decisions for you. This is Felix. See you next time.